Hi everyone and welcome back to a brand new episode. My name is Marcus and I'll be your host. In today's episode, we're going to take a look at Nike or Nike, depending on where in the world you live. Let me know in the comment box below how you guys pronounce it. If you're new to this channel, what we do is that we study and analyze stocks. We go through the fundamentals and the technical analysis of a stock, but we also talk about finance and investing. If you've been here before, thank you so much for coming back. I truly hope you guys will enjoy this episode. And please give me a thumbs up, comment, subscribe, and let me know what you think and also what stocks you want me to take a look at. Thank you so much. Now, let's get started. As I mentioned, we are going to take a look at Nike or Nike, and they are traded at a New York Stock Exchange, and they are a manufacturing sector. Their market capitalization is at $268 billion, and their revenue is at $44.5 billion. Their PE ratio is at 47. Now, you guys know that I like to look at companies with a PE ratio of 20 or below. So that is a no for me. Their profit margin is at 12.9%. I like to take a look at companies with a profit margin of 15% or higher. Having 12.9 is not far-fetched from the threshold, but still lower than what I'm looking at. So this is a no for me. Their price to sales ratio is at 6. Normally, I like to take a look at companies with a price to sales ratio of maximum 2. Having 6 is too high, so therefore a no for me. And the price to book value is at 20. Normally, as you know, I like to take a look at companies with a price to book value of maximum 3. Having 20 as a price to book value is too high. So that is a no for me. So if we summarize, the price to earning PE ratio is too high, the profit margin is too low, the price to sales ratio is too high, and the price to book value is too high. That tells me that the company is overvalued. We need to see the price of the stock fall so it becomes more attractive. But at the current state is too overvalued. Now, the company pays out a dividend of $1.07. I like it. I like the dividend income. So that is a go for me. I like that. Effective return is at 0.6%. That is very low number, and that is a no for me. I don't like that at all. Now, the return on equity is at 55%. I like this. Basically, what return on equity is that it looks at a company's ability to create return on the invested equity. And as for an investor, it's very important to see that the company is able to create a return on your investment. So 55%, I like that. That is a major goal. I like that. Return on assets is at 13%. I like that. I like it, so that is a go. Now, if we look at the price, it's currently traded at $169 per share. And if we take a look at the 50-day moving average, we can see that we are trading above and also trading above the 200-day moving average. This is a clear signal that we might see price move even higher. So if we take a look at the chart, we can see here that we have been consolidating more or less, moving in a channel like this. So basically it has been moving up and down and in a consolidation. And what happened here that made us jump up was the reports came out and pushed the price higher, and we can see, so this tells me there is a gap here. So I expect that the price will have to fill that gap. So further on we might see price move even lower. That's what I expect to see. Now let's move over to the income statement. The first thing we can see here at the income statement is the total revenue, and we went from $34.5 billion in 2017 up to $44.7 billion in 2021. So and we have been it has been growing steadily ever since. We fell off 1 year, but overall we have a good trend. I like that. Gross profit went from $15.3 billion up to $20 billion and has been growing. As we saw above, we fell off 1 year, but overall positive trend. I like that. Net income went from $4.2 billion up to $5.7 billion. We fell off and got back up, so a bit of fluctuation as we can tell here, but overall it's moving in the right direction. I like it, so it's a plus. I'm liking what I'm seeing right now. Now over to the balance sheet. What we can see here is that what we are interested here is that the current assets versus the current liabilities, and we can see that the current assets is much higher than the current liabilities. I like that. That means that if the company converts the current assets to cash, they can pay off their current liabilities. So that is a plus for me. But also they are able to pay off their total liabilities. I like it. Not a huge leg room between the total liabilities and the current asset, but still it's larger than the total liabilities. I like that. So that is a major plus. Now looking at the total liabilities, we went from $10.9 billion up to $25 billion, and it has been growing ever since. A minus. I want to see the company reduce their total liabilities. Now let's move over to the cash flow. And what we are interested here on the cash flow is the operating cash flow, and it went from 3.8 billion up to 6.7 billion and has been growing. We fell off 1 year as we saw previously, but overall positive trend. I like that. But what we are most interested is to see the difference between the capital expenditure and the operating cash flow, and here we can see a difference of almost, well, a $6 billion difference here. So that is a plus, and we can see that it has been improving ever since. So that is a major plus. I like this one. Now let's move over to the key figures. And what we can see here at the key figures is that the earnings per share went from $2.5 per share up to $3.6 per share. We fell off, got back up, and then fell off. I'm seeing a fluctuation, but overall we are moving in a higher position, higher level. So I like that. Revenue per share went from $20 up to $28 and has been growing steadily. Well, we fell off over here, but not by much, and got back up. So I like this one. Equity per share went from $7.5 per share up to $8 per share. Fell off a couple of years, but overall we are getting back to higher numbers. So I like that one. That is a plus. Now dividend per share, we went from $0.6 per share up to $1 per share and has been growing ever since. I like it. I like that income, and that is growing also. It's just a plus. I like that. So that is, you know, I like that income. Now the dividend share went from 26% up to 28%, and 1 year went up to 64%. But overall we have been, my threshold, what I look at, I don't want companies to pay out too much. So my threshold is that we need to I want a company that pays out less than 60%, because I want some of that capital to remain in the business for reinvestment, to become more efficient and so on. So not larger than 60%. That's my threshold. So that is a plus. I like that. Now profitability. Looking at the gross margin, we went from 44% up to 44.6%. Not a huge move, and we have been on these levels for quite some time. It's a small, well, looking at it, the gross margin, that means that their cost of goods sold is high. For instance, if you sell for $1, but you get to keep 44%, that's almost more than 50% that's on your cost of goods sold. That is high. The company needs to find ways to become more efficient and improve the gross margin. Still a large number, but in this case I'll give it a minus because the cost of goods sold is so high. The operating margin at 14% and had moved up to 14.9%. Also not a huge jump. We fell off, got back up, and so a lot of fluctuation. I'll give that a minus, even though it's still positive. I'll give that a minus. Profit margin went from 12% up to 12.8%, and we fell off, got back up, so a lot of fluctuation. And the profit margin is below 50%, so that is a minus. The return on equity, as I mentioned, return on equity is a way for us investors to see the company's ability to create a return on the invested equity, and also for us to see the company's ability to provide us a return on the capital that we invest. So it went from 34% up to 44.8%, and we fell off, got back up, fell off, so a lot of fluctuation, but overall I'm liking the numbers, so that is a plus. Return on asset went from 18% down to 15%, and we fell off, and we can see the small fluctuation. Latest numbers is smaller than what we started 5 years ago, so that is a minus. Solidity, basically what solidity is that it looks at how much of the total assets is financed by the equity, and also gives us a picture about the company's financial strength for the short term. And we went from 53% down to 33.8%, have been falling ever since. We got back up this last year, but overall we are in a downtrend. That is a minus. I'm not liking this. Balance sheet liquidity, same thing as solidity, but here it looks at the company's financial strength for the long term. And here we went from 4.6 down to 2.13, and have been falling where we got back up, but overall we have been falling. I'm not liking this, so this is minus. Now debt ratio went from 0.8 up to 1.9. Basically what it tells us is that the company has 1.9 times more debt than equity in the company, so that is a minus. Now we have gone through the income statement, the balance sheet, the cash flow, the key figures, and now we're going to take a look at the most important part of the software, and that is the pillars. Basically the pillars, what it does is that it gives you a simplified, easy to digest overview, holistic overview of the company's performance. And if we summarize, we can tell by looking at it is that the PE ratio, let me see here, the PE ratio is above 20, so that is a minus. The company pays out dividends, I like that, so that is a plus. Dividend payout is less than 60%, I like that. And the dividend have increased over the past 5 years, I like that. Now the number of outstanding shares have decreased, that is a positive thing, I like that. Basically what it means when outstanding share is decreasing is it means that your share of the company is growing. A lot of people be looking at, for instance, debt. They'll be like, this company is not taking on a lot of debt. But if we look at the numbers of outstanding shares, it has been increasing. Company give out shares in order to bring in capital. So the debt column may not have grown that much, but they have brought in a lot of capital through increasing the number of outstanding shares. And that is a negative thing, because your share of the company is decreasing for every time there is more and more outstanding shares. Now Nike having fewer and fewer outstanding shares, that is a positive thing, I like that. Now revenue increased over the past 5 years, I like that. Profit margin is less than 15%. So this is a minus. I have to report this bug to our developer. Profit increased over the past 5 years. That is a plus. Current asset larger than current liabilities. That is a plus. Solidity decreased over the past 5 years, minus. Balance sheet liquidity decreased over the past 5 years, minus. And debt equity ratio increased over the past 5 years, minus. Guys, as you can tell, it gives you a clear, easy to read picture of the company's performance. And just for $25 per month, you can have this software along with everything we have gone through, plus access to our analysis page where we publish more articles and videos for you to consume. And you get access to our chat where you'll be able to chat with me alongside other members. Now let's move over to the technical analysis of the stock. So here we have the stock, technical analysis of the stock, and what we can see right away is that we had a gap. We have a gap here. Basically it tells me that every time you see there's a gap, you can be certain that the price will go back down or switch, because the price went up or went up gap. That means that this gap needs to be filled again. So most certain that you will see price move back down, fill those gap, and do trade like this. So I'm expecting to see the price go like this in the coming weeks, go down and fill that gap again, and then continue the roll. As we can see here, the price went up. The price went up, and then went in a downtrend channel up here, the bounce, the negative trend, and then the report came out, the earnings report I believe came out and pushed the price up and created a gap. Now the gap will need to be filled again, so I'm expecting the price to fall and then fill the gap and then continue. So I will wait before I trade the stock, and I'll wait for an area over here to do a new recession and look at new ways to enter the trade, or if I will stay away. But trading Nike, I'll choose to stay away from it because I know that the gap needs to be filled again. So that's what my take on the stock right now. What would you do? Let me know in the comment box below. That's it, guys, for this episode. Thank you so much for watching. I truly hope you enjoyed this episode. Please give me a thumbs up, comment, subscribe, and let me know what you think. Also, what stocks you want me to take a look at. Thank you once again for watching. Until next time. Bye-bye.